This conference will now be recorded.
So most time when I first start talking, we just hit general things. I try to have the recording on so we can go ahead and have a recording for the sessions. So we're at a good point in terms of what you need to know. First of all, behind accounting is this accounting equation. Assets equal liabilities plus stockholders' equity. That's the focus of accounting. Stockholders' equity equals common stock plus retained earnings. Retained earnings equal revenues minus expenses minus dividend. So this is the accounting equation expanded. Assets equal liabilities plus common stock plus retained earnings. And we can always pull out cash plus other assets equal liabilities plus common stock plus retained earnings. The first thing that a company does is it has to open up a bank account and put in the business. So in this case, the company, the owners put in $100,000 in cash and it went into the common stock account and they got those shares of stock. That 100,000 belongs to the company. They can't get it out. The purpose of a business is always to increase the cash through earnings, not through borrowing, but through earnings. So whenever we're looking at a company, when you're trying to analyze what's going on, you want to look at, okay, how much did the owners put in? How much cash you got now? And did it come from earnings? So just kind of keep that in mind. Let's move on to double entry accounting. So in accounting, way back in the 1400s, Pacioli here decided that in terms of accounting for transactions, in any transaction, there's always two parties. Okay. So when you got a transaction, there's two parties. If you go to the grocery store, there's two parties, you and the store. When you engage in a transaction, you receive something of credit, that's a debit. You give up something of credit, something of value, that's a credit. So you receive something of value, you give up something of value. For you receive food, you give up cash, or you use a credit card. For the grocery store, they get your cash, a credit card slip, they give up an inventory of food. What you receive is always on the left side of an account. That's the debit side. What you give up is a credit. So once again, in accounting transactions involve two parties. And we're looking at the business party now. We're not looking at the consumer per se. So you've been on this side a lot, the consumer part. We're looking at the business side. If you're running the business, what did you give up? And what did you get? So when we have double entry accounting, you got to have at least two accounts. And as we said, the debit is on the left side and the credit is on the right side. In general, we expect assets and we want assets to be debits, and we debit the assets. We want the liabilities to be credits, common stock credits. Debits equal the credits, so the credits for common stock and retained earnings and revenues are good. These debits are good, but these debits for expenses are not good. So it just depends on what side you are. But debits on the left are good, credits on the right are good. So that's that accounting equation showing, okay, we double entry, We have debits on one side equaling to the credits and a few bad debits on the other side. So suppose I gave you this situation where you had these cash transactions. You had an increase of 50, decrease of 10, increase of 50, decrease of 15, decrease of 3, increase of 15, decrease of 4, decrease of 2, increase of 2, decrease of 8. How much cash do you have? As we take a little break in the action, how much cash do y'all have if you have these? If this is your bank account, how much cash you got now? Don't have any?
25.
How much?
25.
But I couldn't hear you. Say it louder.
25,000.
5,000. Okay, somebody says we have 25,000. So how do we get 25,000? And in accounting, what we would do would be all the increases, we put it on one side. All the decreases, we put on the other side. We add up the debits, we add up the credits and take the difference. So you may have just gone and calculated it this way, or you may have looked down further. But in accounting, another role of debits and credits is to, we don't go plusing and minusing like this. We put the, instead, whenever there's an increase in cash, we're going to debit. When there's a decrease in cash, we're going to credit it. Then we're going to add these up and take the difference. Let's just take a little foray into Excel for a second to show you how this would work. So if we're using Excel, you see how you did this time if you're trying to add it up and subtract it. But what we would have done would have been to put these transactions in like this. So we'll just copy them, then we'll paste them in here. Okay, council, not the same size. Let me come down here and put it down here. Might not let me paste it. Okay, they let me paste it here. So let's assume the cash account is down here. So let's see what we do with Excel. In Excel, we're going to go and sum these debits. And we'll hit auto sum, and it's going to put it there. We're going to also sum the credits. And we're going to hit auto sum again. And it's going to tell us the debits are 67 and the credits are 42. Then to get our balance, we're going to put a simple equation in with Excel. We're going to hit equal. Then we're going to put in parentheses. We're going to click on this cell where the 67 is. We're going to put a minus sign in. Then we're going to click on this cell where the 42 is. We're going to put another parentheses. We got our balance. So this is what we're able to do with Excel. Okay. So this is what you're going to be doing in the course. So you aren't going to be using a calculator or a cell phone to make your calculations. You're going to have them on an Excel spreadsheet and make that calculation. It's going to be much more accurate, time saving, and everything. So that's just a little break into action to show you how we're going to be using Excel and how important. As you work with that, you'll see that that's probably a lot easier and quicker way to get that done. Let's look at double entry accounting a little bit. Suppose we bought an auto and we paid cash of $10,000. We debit the auto $10,000. We got $10,000. That's what we received. We credit cash for $10,000. So we got an auto. That's what we got. We gave up cash. Or we could have signed a note for it. We still got an auto. That's what we got. But now the credit is to note payable. Or we could have done a combination. We could have bought the auto, paid cash down of $2,000, and credited notes payable $8,000. So sometimes there can be more. Got to be at least two accounts, but sometimes there can be more than two accounts. But the key, the debit still got to equal the credits on each side. So this is showing you double entry as you record. What did you get a value? What did you give up? First case, you got the auto, you gave up cash. Second case, you got auto, you gave the vendor a note payable, which you got to pay on. The third time, you got the cash, you gave up the auto, you gave up cash, and you gave up a note payable. So it's a combination. So there's always two sides to the transaction for you. What did you get? What did you give up? Let's move on to the accounting cycle. And in this accounting cycle, so we've got 9 steps. And we got to go through all of those steps and got to get right here to 7 so we can get our financial statements. Then we'll do 8 and 9 also. So those are the 9 steps that you'll be doing at midterm. But for these first 2 weeks, we're just doing steps 1 and 2. We're going to analyze transactions and make journal entries. So that is all we're doing for this first 2 weeks. Can't get steps 1 and 2 done, you cannot go to steps 3, 4, 5, 6, and 7. So I want to make sure everybody can do steps 1 and 2. And in terms of making journal entries, I've already showed you that problem. Everybody is going to have to make a journal entry starting 1 week from today. So everybody in the class has a journal entry, and you getting your journal entry right is worth 10 points. Okay, so we got to go through all of these, and we'll get through them. We'll get through them by midterm, but I want to get 1 and 2 first. Just analyze each transaction, journalize it. We'll get to the others later. So in making journal entries, every time there's a financial transaction, you got to make a journal entry. Each journal entry, as we just said, requires an equal debit and credit. You're going to read the transaction, determine what type of journal entry it is from the journal entry types. So, this is where, I put in the additional information. We'll get to it in just a second. How do debits and credits impact accounts? And we'll review this next time. A debit increases the asset account and a credit decreases it. A credit increases a liability account and a debit decreases it. For common stock, a credit increases it, a debit decreases it. For retained earnings, credits increase it. For dividends and expenses, debits increase those accounts. So this, we'll come back to this next time, but it's just a little table, these tables to help you as we get ready to make journal entries. Okay, so this is what you're supposed to have a copy of, transaction types next time. What I have here are the 20 journal entries that we will make in this course, the 20 journal entries. But right now, for this first 2 weeks, you only got to be certain ones in bold. So you got to be able to do 1, 2, 3, and 5, 7, 8, 9, and 10, 12, and 15. So those are the only accounts that we're going to be working with now. Now, what this transaction type does is it tells us, first of all, we have transactions where cash increases, so we're going to debit cash. So whenever we have cash transactions where cash increases, we debit cash. There are 6 of these. We're only doing 4 of them now. So there are 6 of them, but we're just doing 4. Anytime we look at a transaction and it's a type 1 through 6, cash is always debited. Then the chart is telling you what's credited. If it's a type 1, common stock is credited. If it's a type 2, revenue. Type 3, receivables. Type 4, note payable. Then we get to transaction 7 through 11. This is when cash is paid out or cash decreases. On these transactions, cash is always credited. And then you debit, if you purchase an asset, you debit the asset purchase. If you pay a liability, you debit that. But in 7 through 11, cash is always credited, and whatever is paid is debited. So 1 through 6, we debit cash. 7 through 11, you credit cash as you make your journal entries. Then we have 12 where you purchase an asset utilizing debt. So you didn't use cash. So you debit the asset purchase and you credit the liability created. So this is like if you're using your credit card to buy something as opposed to your debit card and you're paying cash. Then we got one other, we look at 15, sale on account. This is when you do the work and earn the revenue, but you haven't been paid yet. You do the work and you earn the revenue, but you have not been paid yet. So what I have here are the 20-some journal entries that you're going to have in the semester. And right now, I guess this is 10 that we're working with now because we aren't really doing the cash refunds yet. So whenever I ask you for what type of journal entry it is, you know it's got to be 1, 2, 3, or 5, or 7, 8, 9, or 10, 12, or 15. Now, once you know what accounts are involved, then this is when you go to the chart of accounts. And you got to pick out an account with a number and put that in the journal entry. So it tells you, you're told what accounts, but you got to come in here and determine whether it's an asset, a liability, revenue, or an expense. You got to pick out one of these. You do not create any other account names. You got to come in here and get an account that has a number by it. So you don't put any other names down in the journal entry. I already got the accounts and numbers. I want you to utilize them. You utilize these. So you determine the journal entry type. And then you go through, get the right accounts, and you put them in the journal entries. So let's just see if we can look at some illustrations of this. Okay, so our first journal entry, we invested $100,000 into the business. Okay, so we invested $100,000 into the business. The first thing we're going to do is come in here and see, okay, what type of transaction is it? And this is this, we invested $100,000 into the business. So this is transaction type 1. So in transaction types, we're going to put a 1 here. Okay. It says we have to debit cash and credit common stocks. That's basically we just debiting cash and crediting common stock all the time. Okay. So now I've got to go in here into my chart of accounts, get an account name and number, cash 100. Then I got to go to common stock and get 400. So I got to go here now and get accounts and numbers. So now I'm ready to make the journal entry. I'm gonna put 100 here. I'm gonna put cash. Then I'm gonna put common stock, put the number 400. Put common stock. I'm gonna put it on the credit side. And this is all we're doing for the first 2 weeks, making journal entries, doing this. Now, sometime, in semesters past, I said people could do this. Let me just say this quickly, do this and go on. But by the time I got to midterm, I would get some surprises. And people have to go through all those steps, but they couldn't get to this one step. So I said, well, what I'm gonna do, I'm gonna spend 2 weeks on this. And everybody gonna make at least one journal entry. Everybody in the class got to make a journal entry. Let's go to transaction 2. And in transaction 2, it says we received car loan revenue of $50,000. Okay, we received car loan revenue of $50,000. So I got to go here and get me a journal entry type. So when I look in here, cash revenue received, that's type 2. It says I debit cash and credit revenue of sales. I debit cash and credit revenue of sales. So I already know cash is 100. So that's the account that's going to be debited. Then I got to find an account of credits. So I'm going to come in here, look at my revenue, sales 500. So that's the account I'm going to credit. Of course, this was a type 2, so that's the first thing I'd ask you. And then our amount is 50,000. So every time there's a transaction, we read the transaction, Then we go and figure out, okay, what type it is. We get our accounts needed after that. So the third one, it says collection of cash on accounts from corporate customers. So I kind of got these in order. Cash is coming in. So whatever cash is coming in, I got to be 1 through 6. So here, collection of account receivable. So collection on corporate accounts, that's collection of account receivable. That's a type 3. It tells me I'm going to debit cash and credit account receivable. Then I got to go in here. Okay, where's my number for account receivable? That's 110. So I'm debiting cash. And my type is 3. I'm debiting cash for 20,000. And I'm crediting account receivable, which is 110. So we're just learning how to record transactions. And the next one, receipt of a short-term working capital loan, 25,000. I'm gonna go back to my types. And I realize that's borrowing money. So it tells me I debit cash and credit notes payable. So my type is a 5. So this is number transaction 4, and my type is a 5. Once again, we debiting cash. I just got these in order. And we got to go ahead and see if we can find an account. Since it's a short-term working capital loan, I'm gonna come in here and look at let's see, accounts payable, salaries payable. We'll just pick up notes payable. Sometime we would have a short-term notes payable. So we just go ahead and put this 350 in since it's a note payable. And that's 25,000. So every business in the world does this. Every time they got a financial transaction, they make a journal entry. Now they're going to have a sophisticated Excel program, but somebody has to input this information. Yeah, somebody has to do that. So we've done the first 4 where we have received cash. Number 5 says we purchase supplies paying cash. So what are we going to do here? We purchase supplies paying cash. What type is that? Do I have an A student in the house today? Are there any A students this afternoon? No A students? Oh, something wrong with y'all. Half my students typically make A's in most of my classes, but I guess sometimes there'll be exceptions. Okay, so it says that we bought supplies for $2,000, right? 1,000. So we paid 1,000 in cash. So we know we paying cash, so we got to be 7 through 11. It's got to be. So which one is it? It's an asset.
Is it 7?
It's going to be 7. So our type is going to be 7. So here, okay, we know that that second account is going to be what? Cash, because we're paying cash. But what's the top account going to be? What do we buy? We bought supplies. So the asset purchase was supplies. That's 130. So we're going to put the 130 here. And the amount was supplies 1,000. Wrong line. Okay, then I'm gonna jump now to number 9, where we purchase supplies on account. So I'm going to transaction 9, where we purchase supplies on account. What's my type going to be now? So I'm on transaction 9. So we can go today. Let y'all rest your brains a little bit. What type transaction is that? Which one is it? We purchase supplies.
Is it 7 again? Well, purchase an asset, but the type of account, like how it was for number 5?
In number 5, I paid cash. Number 9, I did it on account.
Oh, okay.
So it can't be 1 through 11. It's got to be what? Type has to be what? 12.
12.
Oh, okay. I was gonna say 12.
Not 15. This is buying. 15 is when we sell something. So it says purchase of an asset utilizing debt. We're going to debit the asset purchase and credit the liability created. We're going to debit the asset purchase and credit the liability created. Excuse me. Okay. So we now need to go to our what? Chart of accounts. What did we buy? Well, it was some supplies, right? So we can debit supplies for 130. But how did we pay for the supplies? We bought it on account, so we can go to account payable 301. Account payable 301. Extra one in here. What was our amount? 8,000.
Yes.
Okay. Are there any questions? So you can finish those up.